Good morning and welcome to Trading with Larry, ex-Larry. Larry's not here today, so it's me and Clint. Good morning, Clint. Good morning, everyone. Hope everyone's having a good week and a good start to the new year. Overall, I would characterize the market as trying to feel things out this year, even though it's up a little bit. But that's the feeling I get so far in 2026. At least here in the U.S. markets, overseas markets are much stronger, and that's a trend that is carrying through from last year. And there are several trends that are carrying through from last year in precious metals. Obviously, now silver almost at 92. And Clint, you and I were talking about that, how crazy it's been with silver, and we were joking around, but we were like, you know what? Maybe we wake up one day and there could be some giant geopolitical thing happening in the world. I don't want to say war, but I don't know. Chess pieces are starting to move around on the board. Uh, and, gold is like unreachable, untouchable. So this is where we're at. I know it's overbought, but that's a trend that's also continuing from last year. And at the same time, I'm seeing a lot of trends that are about to get broken or threatening to get broken. Housing has been in a bear market, and uh, home building stocks are flying. Um, you know, it was interesting last week. We had those headlines on from Trump, and he wants to ban single family home buying. Builders dropped, Blackstone dropped 10%. He then attacked the defense industry. So, like, Lockheed Martin drops a lot. The next day, they come roaring back and then some. And I was looking at financials where he went after them with the cap on interest rates over the weekend. And they didn't come back yesterday because of earnings. So they've gotten knocked down 2 days in a row now. And now I'm looking at financials. I'm like, okay, well, they weren't able to come back, and we have some more earnings on tap today from financials. And the one stock I have, there's a set space on your trading screen, so you got to be careful what you're looking at. And I have today. I have J.P. Morgan on my screen. I haven't had that on my screen. I've had it on my watch list, but I don't really trade J.P. Morgan. But I'm watching that one for the next couple of days, and then obviously we have the Supreme Court decision. Hopefully, we get that today. And before I send it over to you, I just want to talk about what the options market has been pricing in for today's big Supreme Court decision. So I'll rewind back to last Thursday because we were supposed to get the decision on Friday. So this was obviously, I don't want to say overhyped event because we don't know what's going to happen. And uh, I think it's an important event, but for sure, all of us analysts and traders are looking at this and hyping this up. The options market, even with the jobs report on Friday, was only pricing in a 45-point straddle, which in the grand scheme of things is not a lot. Right? It's less than a 1% range for S&P 500. Um, that came and went. Nothing burger, right? They pushed the announcement for this week. Yesterday, the straddle was pricing in 32 points at the close. 32 points. Basically pricing in another nothing burger, even though we're hyping this up. The market's already down today. I would say, 30 points, and the straddle is still at 32. That's with that 30-point drop. So maybe the options market was right on Friday, but wrong today. So I'll throw it to you. Let me know what you're thinking.
Yeah. So first on the straddle, just one thing I would point out consistently that we've seen over the last week, we have not. been doing much in S&P Trader. That's the one where we'll use some of the information provided by the straddle. We'll check our levels at the open and see if it makes sense to put on a credit spread trade on the S&P 500. You talk about iron condors a lot. We tend to come out and make a directional bet first, and then if we need to do something on the other side of that, we will. But the key point here is that we've slowed our activity significantly over the past week because you're just not getting compensated for the type of swings that we're seeing. So, you talk about the straddle being around 30 points. When we go in right after the open and, we're looking, 30, 35 points higher or lower from where the S&P is trading at, you're barely collecting, a dollar 35 on those spread trades. And you're seeing swings that are outpacing, what is indicated by the straddle. And so, this, a huge part of this and being successful in trading is controlling risk and control and looking at, what type of reward you're collecting to put that risk on. And that reward has just been really small at the open for, like I said, probably the last, at least, since last Thursday or so. So that's one thing I would note is that the straddle has been very low relative to the actual swings that we're seeing in the market. And then today, today, like you said, it's going to be all about Supreme Court. I think they indicated that might be out around 10 a.m. So, we'll be open when that likely be open when that comes out. And right now, I was just looking at poly market odds. It's a 27% chance that the Supreme Court rules in favor of the tariffs. I was talking about this with Larry. Like you could tell me what the decision is, and I don't know that I would want to bet on the market direction. Like you could give me that inside information, and I don't know that I would want to take a stab at how the market is going to respond because I could see either way. I think if they reject them, I actually think it could be kind of a bad thing for the market, and that it's going to uh, add this element of uncertainty because you don't know how Trump is going to respond to that. I think it's actually probably more favorable if they uphold him because then it's like he can take his victory lap, and the markets come to terms with it. Obviously, since last April, and we continue with the status quo, and hopefully there's no new developments. That would be how I look at that right now. But so that's
Yeah, I think that's well said. I think that's well said, and you mentioned come to terms with that. The market has come to terms with that. This is, I think, 100% true. I think that's why I have my thoughts on it, and I asked the AI, what does the AI think? What does ChatGPT think about the odds and the market outcome? I always do that before a big event. By the way, any big event like you just mentioned, I think it was a good thing you said. Where even if you give me the outcome, like I don't know, I don't know what to do with it. Right? As a rule of thumb, before these big events, I go in nice and flat in my book. Aside from any kind of small core positions that I want to hold for longer periods, and I just trade around that. I think today is a good that's a good approach. But yeah, even if we knew the outcome, I as well would not know what to do with it. But here's what the AI is saying. Right? It's saying there's about a 40% or 30, somewhere like 40% chance that they will actually rule against it, but they're going to soften it up and somehow allow Trump to carry forward with the tariffs. Uh, and then you mentioned the market coming to terms with it. You look at a company like UPS, which is finally, I think it was, like a poster child for the chaos that tariffs caused to companies dealing with shipping and with supply chains. Yeah, these companies have come to terms with it. They've invested a lot of money in re-navigating how they do business. If we go back to square one, I don't think that would be a net positive thing in the short term. Maybe even in the long term. So, yeah, I agree with that. I think status quo gets the market happy. And yeah, the you mentioned the straddles and not getting compensated. I think it's interesting. The last few days, even though you're having like gyrations in the market, the trade was pretty much iron condor. Like it stayed within straddle levels that were priced at the open. Now, was it comfortable? No. So, I just want to share with people how I kind of handle that. For me, there's like a set ingredient for, okay, this is going to be an iron condor kind of day. I'm looking for low volatility and I'm looking for market breadth that is churning. Like yesterday had the market breadth that was churning. I think the advanced decline line was right at like 50%. But you did have like a little bit of an uptick in vol, and that made iron condors a little bit uncomfortable. But that's typically like the ingredient: low vol, a market churning. Typically, the market's going to stay in a range. But yeah, like you said, it's not comfortable because you're not getting compensated. And I made a comment yesterday. Well, how do you handle that? Do you just go into that at 9:30 when there's premium? What I like to do is set limit orders on both sides of where I think the range is going to be, and basically tell the market how I want to get compensated for selling that strike. So, if the market is telling you 30 points down, we're going to pay you $1.25. In a market like this where vol is low and you can get a 20-point swing, that $1.25 credit spread could become $4 pretty quickly, and you know and still go out worthless. So I think limit orders are a good way to handle it, like where you want where you think the strikes are, where the market is going to stay in between the strikes. Put in some limit orders, and just like, I hate to use the cliche, but let the market come to you.
Yeah, well, that or what I would say too, you can do is be a good linebacker and read and react. So a lot of times, what we'll do is right after the open, if we don't like what we see, but we get kind of a big directional move, especially one implied by the straddle, we'll look to sell something, on that side. So for instance, if market opens and we get a big pop within the first 15 to 30 minutes of trading, we'll likely look to sell a call spread into that. Same thing on the other side. If we get a big dip shortly after the open, then we can look to sell the put spread into that. So we can use some of that direction at the open to get a little bit further out, to help control risk and help ensure that we're going to keep that premium we're collecting. That's a way that we'll look at the markets a lot. If we don't do something right at the open and you see a trade come across at 10 a.m., that's likely what happened is we got that directional move, and so now we want to sell that side of it.
Yeah, I'm getting a question on the chat, like what range do I see today? Yesterday I was able to tell you, the day before, I was able to. I can't tell you today. Like I don't know what the range is going to be today.
Would you say the straddle's
Um,
at 30, around 30 right now?
yeah, that the straddle's around 30 right now, with the market already down
Yeah.
30.
So
Okay, so
that still seems low relative to how much anticipation is built around this Supreme Court ruling.
well, okay, so here's the thing, right? The straddle at the close yesterday was also 32. So with a 30-point down move pre-market, it's still at 30. Is a little bit more reasonable. I don't know. Again, I don't know how the market is going to react to this. I don't know what the ruling is. I think the odds we're seeing. I think what did you mention on Polymarket? Like 20%.
27% that they rule in favor of the tariffs.
So okay, and what are the odds that they rule against it?
I didn't see
Probably
that
the
one.
same
I
20.
pulled that up really quick.
Yeah. So I would say it's probably kind of like similar. Plus or minus 5-10%. I don't know. For me. I'm just sitting back today until the stuff comes out. I'm gonna let the market do its stupid thing, which is overreact, then underreact, and overreact, and then You know, when it's like a little bit less, when it's more certain of price action. I think that's my plan today. So for you guys in the chat asking me what range do I see today, I have no idea. And whereas yesterday I was able to tell you because a lot of this has to do with the economic calendar, like what's on tap, um, and also it's earnings season. Earnings season is. I mentioned I like iron condors when the market is churning, when the advanced decline line is 50-50. That's when I like it. Earnings are great for that because the market is just going to fixate on one sector. Like yesterday, they were fixated on selling financials, right? And so, like Larry says, and we talk about all the time, like they're selling one thing, buying the other. And so that creates that churn where they're fixated on one sector and they'll like put their money into other areas and just sell where the news is. And that creates churn and the market is kind of range bound. Today I just it's a wild card for me.
Is there anything you like to trade? And is there anything you like to trade on the individual names on heading into earnings?
Uh no. Actually, well, it's stuff like people don't usually trade. I think there's a little bit more edge. I don't think there's a lot of edge like trading the big names. I don't know if you find that. Like
No,
I'll
I
never
don't.
put.
I don't. That's why I asked you.
So I like to trade like stuff that like people aren't paying attention to into earnings. I'll take bets on that. Like I still feel like people aren't paying attention to some of the like I'm in Homebuilders right now. That's my biggest piece. There's a company out there, Intercontinental Exchange, ICE. You know what ICE is, right?
Yeah,
They have a hidden kind of real estate play in there with their Encompass platform. It's a mortgage. A lot of people don't know they have it. A lot of people don't know it's a market leader in that. So if real estate picks up, their platform is going to pick up, and that's the growth engine for ICE. Like ICE is like CME, but they also have this Encompass platform. So that's the kind of thing where you kind of go in before earnings if you're bullish, and the market might get surprised because they're not looking at it. They're just not looking at it. Nobody knows. But Nvidia, everybody's looking at. Apple, everybody's looking at. I just don't. I can't compete with that into earnings. Like I could compete with that after earnings, just trading price action. But into earnings, I can't compete with stocks like
yeah.
that.
It feels like I wondered this because it feels like at least with maybe Tesla and Nvidia, sort of the if you look at the a straddle heading into earnings, and this is just my own recency bias speaking, but that if you were selling a straddle into earnings, you did pretty good because the reactions have been somewhat muted on those. But I mean, that's just at the same time, that's a little bit of not a little bit. That's a lot of bit of a gamble to be to put on a straddle into earnings, especially for a closely watched name where a lot of people are looking to trade it.
You talk about trading into earnings. So there's a few ways to trade earnings. You can trade. Um, so a lot of these, like Coinbase, is going to come out early February. Palantir February, but you have a lot of options that are expiring like January 30th. So I have a few positions on some of these names where I think, like Coinbase, for instance, I have put spreads on Coinbase into January 30th. Um, I'm thinking most of the down move. I mean, it got hit really good, right? Coinbase on the decline in crypto. So you could trade like I like to trade as we get closer to earnings, and then I feel like the stock kind of calms down. You can sell credit spreads around that. I'm choosing to sell put spreads, but I have bearish positions too into that. Like I put on, I got a little bit more aggressive with Palantir. to the downside yesterday. I don't know what you think of that. What do you think of Palantir?
So you're selling put spreads on that one, or
So no,
selling? You're
I
selling
had
call
call
spreads.
spreads on it. I have call spreads on Palantir.
I
I
think,
have but I got more aggressive yesterday and bought a butterfly, a broken wing butterfly with puts. So I'm getting pretty bearish on it. But the way that I did it, because it's a broken butterfly, I actually got a credit for that. So if I'm wrong and Palantir goes up, I'll actually make a few cents on that butterfly. You know what I mean?
yeah, I think this AI trade's interesting right now, just because you saw a lot of these names peak out back in October, including Palantir, Nvidia. I think Microsoft, several, Google's been maybe the standout, but a lot of these names peak back in October, and they've been a laggard here recently. We've had a really, especially from a breadth perspective, we've had a really strong start to 2026. You talked about UPS earlier. If you look at the transports ETF, if you look at IYT broke out to a record high. Small caps are breaking out to a record high. This is like this is like the antithesis trade of what you saw last year. For actually, I mean, for a good chunk of the
Yeah.
market actions, 2023, 2024. I mean, now it's going, who knows, maybe it's just in, end of year or start of year rebalancing, repositioning, but Palantir's part of it. But I mean,
Do
I
you
think it's
think
just,
that's what it is? Do you think it's just rebalancing, repositioning, or do you think the
I,
market is
yeah,
in the
no,
middle of?
I think it could definitely be part of that. I also think, what I would say is follow the earnings growth and follow where the earnings revisions are occurring at. And if you look at
Well, I think we lost Clint just for a minute. I'm sure he'll be back. But to Clint, you there? You're back or you're not? I think he's going to join in a minute. Sorry about that. There you are.
Oh, all right, yeah,
There
I'm
you
back.
are.
I don't know what happened. I don't. I don't know where I got cut off at.
I think you were talking about whether
But
the exit from
I was
growth
just
stocks.
highlighting. I think a big move into breadth this year.
You still there? I think still some technical issues, but I just want to highlight something, and I'll pull up a chart of the way that I see this transition away from big tech growth. As I'm pulling it up, I'll just discuss it briefly. But basically, as Clint was saying, the there's been a massive rotation out of Mag sevens, right? So, and you're seeing that a lot in the spread between S&P and Nasdaq, and typically, right, as Clint mentioned, you're not going to see it underperform for too long. But it's now been a few months, and I'll go over all these annotations here, but basically what you're looking at here is the as the chart continues to load, you're seeing the Nasdaq S&P spread, which is in a downtrend. I think what's happening here is a repricing of growth. We talked about it a lot last year. They're like, okay, we're making these deals in AI, and this one's buying that one's investing in this one, and it's all like one big incestuous thing within tech. It's all like one company. It's like it's become almost too big to fail. So the expectations, I think, were unreasonable. I think the market is now in a trend that is more than 3 months long of this spread declining. And as Clint mentioned, this year, this spread, like it's had some. big intraday reversals, which is very uncommon for the month of January, given how the market is actually up and this spread isn't doing anything except being sold at rallies. It's pretty concerning. So I think what's happening is a repricing of growth. I actually think this is a spread to sell on rallies or breakdowns. Like this is something that I will want to follow on momentum to the downside. And I think it's setting up for a great year of trading because it gives you the opportunity to go long other stuff. I think the market is now getting into a period where they're less myopic. Like last year, they were completely myopic, focused on seven stocks. This year, I think already it's shaping up to be completely different. I don't know if you're back. Yeah, you're back.
Yeah, I should be back. Hear me okay?
Hear you good.
Perfect. Yeah, that part. Yeah, I was following your chart there, and yeah, part of what I was saying before I cut out was just following where the earnings growth is happening at, and you're starting to see, at least based on estimates into throughout 2026. The other 493 earnings estimates, the growth rates start to accelerate beyond what you're seeing with the Mag 7. So one thing I say when it comes to how equities react to things, follow the rate of change. Follow the rate of change in something. It's not necessarily the level, it's where the rate of change is improving or getting worse. And if the rate of change is improving in earnings growth for the other 493, I think that's why a big driver of why you've seen the start to the year that we've had so far.
What is rate of change? Is that like a technical indicator of some sort?
Yeah, not even a technical indicator. I mean, it's just so if I let's take the money supply for example. If I want to evaluate the impact of the money supply on the stock market, I won't look at the level of the money supply. I will look at the year over year rate of change in the money supply. If you get the year over year rate of change in the money supply is starting to accelerate from a low level, that is historically correlated with rising stock prices.
Mm-hmm. Yeah,
So
basically
same
you're
thing
saying
with
follow the liquidity.
yeah, follow the liquidity and follow that rate of change. Like one of the like people used to follow leading economic indicators more closely. It seems like they've been wrong for the better part of a couple years now. The conference board's LEI. But if you look at when the regime of LEI, when equity returns are the most positive, it's when the LEI is starting to turn up from a very negative level. Where stock returns tend to be the worst is when LEI is turning lower from a very high level. It's more so on the rate of change of if things are getting better or worse. Again, just broadly speaking.
Do you think at the end of the day, this is all just about liquidity? Like liquidity up, asset prices up. Liquidity down, asset prices up.
I think I think it's a huge impact.
Yeah.
It all comes back to financial conditions. If you liquidity impacts financial conditions, Fed raising rates or cutting rates impacts financial conditions. If you pull up the Chicago Feds, they have a pretty good financial conditions index, and it's running at the loosest level since 2021. So that's been again, you can follow the rate of change of that thing. I mean, that's been a pretty much a bullish tailwind for the market over the last couple years. That would be one major thing I would look for to see a change in if you start to see financial conditions tighten overall. Because we can talk about M2, we can talk about liquidity, but there's they're tabulating like hundreds of indicators that go into this financial conditions index. And so when you look across the board at everything, we're much looser than average right now, which historically that's a boost for the economy, which would supposedly support the earnings outlook, but then that supports stock prices as well.
So rate cuts. Does that, in your view, increase liquidity as soon as they put them on? Like, let's say, we have a Fed meeting in March, and there's some debate whether we get one or not in terms of a rate cut. Let's say they cut rates. Do you think that adds liquidity as soon as they do that? in the plumbing of the economic system, or do you think that?
Not necessarily, because what they say, there's a 6 month lag effect from the time the Fed does something on rates to the time it's actually felt in the economy. So it's like, what's the impact of Fed rate cuts, or how does that flow through? Well, what they're doing is they're making credit cheaper. So then, yeah, there's a
Where
lag effect.
where
Credit becomes cheaper. Does that encourage more borrowing? Like, that's
right?
the
But where are
what's
they making
that?
the credit cheaper? They're making it cheaper on the overnight rate between the banks themselves, right?
Between the banks themselves, but that Fed funds rate impacts the prime rate. So the prime rate follows the Fed funds rate, and the prime rate is the rate at which, like, a lot of business loans are set at. So there's a flow through to other lending rate felt.
Well, do you think the actual act of lowering the overnight rate, uh, produces a? So you don't think it produces a liquidity effect right away? You think there's a lag to it, right?
Well, so all right, there's a lag effect from when liquidity actually impacts the market, but stock prices discount future conditions. And so, are we talking about the impact on the economy, or are we talking about the reaction from the market? Because they're linked, but they're two kind of different things.
Yeah, both. I think what you're saying is the stock market is pricing that in way ahead of time,
Right.
and the economy is not. Basically, they're yeah.
I think the Fed, you talk about the odds of a rate cut. It's going to be interesting with this most recent CPI number. Did you look at the components of that at all? Do you have any thoughts on whether or not that 2.7% was a real or a fake number?
They're all fake. I don't think there. Government reports are government reports. I mean, they're not. they're whatever. But I think there was a lot of truth in it because grocery prices were up, the cost of living. The way that the CPI doesn't measure what normal everyday Americans feel. And within the components, you did see an uptick in why normal everyday Americans aren't happy. Grocery prices went up, the cost of home insurance went up, things that people need every day, like fixed costs to live, have gone up. Other measures of inflation uh, that impact institutions may have come down, but what's impacting uh, you know everyday people has gone up. So I think I think there's truth in that. At least the CPI report is showing that. Whether overall inflation is exactly 2.6345, it does it. You know what I mean? Like, does it? Is it real? Like, do we need
Yeah,
to like? Um, and the other thing, when I saw that in the components, and I'm thinking back to why Trump is attacking single family buying from institutions, and he's trying to put a cap on credit card rates. And what he does really well is identify the political narrative that is working, and then he steals it and makes it his own. And I think what he's doing with the Democrats right now is he's kind of bitching them up a little bit and stealing their own agenda of the affordability. They have this affordability agenda, and he's trying to make it his own into the midterms.
yeah,
That's what I'm seeing from the CPI in terms of what I'm seeing for the effect on rate cuts. I mean,
exactly.
obviously,
Yeah, that's what I was going to say.
yeah. I mean, it's supportive of they're seeing a 2.6% inflation rate, and they're patting themselves on the back, and they're like, "Hey, it's a good thing that we cut rates. We were right to cut rates." I think that's what they're thinking.
He called it risk management cuts, is what they called it.
Yeah, risk manage. Yeah, risk management for what? For a declining jobs growth, increased.
Yeah, because yeah, I mean payrolls averaged a gain of 49,000 in 2025. That number was 168,000 the year before.
Yeah, I mean the last jobs report we had on
So I mean
Friday.
those.
Like, what did you think of the jobs report last Friday? Did you think it was strong or weak?
I mean, so all in, here's my problem with payrolls report is that there's so much attention placed toward it. It drives such a big response from the Fed. Like you could be months beyond what the original data point was, and there's a massive revision to it. So, for instance, the December number coming in worse than expected. It was 50,000 was the jobs growth number. Economists were expecting 73,000 to a loss of 173,000. Like the original estimate was like for a loss of 100,000, it got revised to 173,000. Like, and then they go back and they make these huge annual revisions periodically or once a year. And so I don't know how a month or two later you see this massive revision, and then several months later you see another massive revision. And like this is supposed to be a thing driving the Fed's response to how they change interest rates. It's just this is why it's such a lagging variable. I mean, this is why they're always late to adjust.
Yeah, it's the snippets I'm hearing from you sound very interesting, but you're unfortunately technically like I think yeah the sound is coming in and out. So I think we're gonna let's kind of like just discuss final thoughts into the day. It is 9:07. Market is currently down now 30 points. Nasdaq is down 160 points. So Nasdaq leading the decline a little bit. Again, I'm watching JP Morgan today. Put that on your screen, which is down another percent pre-market. We're going to have potentially Supreme Court comment on tariffs at 10 a.m. Potentially. I'm not sure when exactly that's going to happen. I think this is a day where, less is more. Technically, right now, the ES futures have broken through their short term 5 and 8 day simple moving average. So they have lost a little bit of momentum here, which was precarious to begin with. So, market on the ropes a little bit here pre market. So, typically I'll give something, but I'm just waiting. I'm trying to be as flat as possible, other than longer term positions, short Palantir, long Coinbase, and that's it. And that's pretty much it. I don't know where Clint went. I think he is having some technical issues, but that's it. It is 9:09. Let the if on any day you want to let the market come to you, I would say today is the type of day where you want to do that. So just be careful out there. Gold is up again on I think on geopolitical increasing geopolitical risk premium. I think that's what is happening with gold. And final thought on silver. Silver's now at 92, and we're supposed to be in the middle of this passive commodity index rebalance where they need to naturally sell silver to get it down to a certain percentage of the total allocation. And despite that, silver is at 92. So, that's all I'll say about that. I want to thank Clint for joining if he's there. Nice talking to you. Always get good perspective. And everybody have a great rest of your day. Good luck.